I apologize for the delay of today's live broadcast. March 15th is there, and I had some urgent customer client coming in, walking in, and he needed the return right away. So, apologize for that. Okay, so today we are going to discuss tax saving strategy for S Corp. And on the other note, March 15th is tomorrow. If you have not filed your tax returns, you should file extension. But remember, filing extension doesn't mean that you don't have to pay taxes. Your taxes are still due by tomorrow. So let's dive in. S corporations offer a compelling choice for business owners aiming for tax efficiency and flexibility. With their unique tax benefits, including pass through taxation and reduced self employment taxes, S Corp stands out as a versatile business structure. This concise overview will highlight the key advantages of S Corp, emphasizing the strategic importance of compliance and planning. Ideal for entrepreneurs evaluating this business structure option, understanding S Corps can significantly impact decision making and business structure. Let's delve deeper into the concept of pass through taxation with a more detailed example to illustrate how it works for an S corporation and the benefits it provides to its shareholders. Understanding the pass through taxation. S corp and partnerships, they are both pass through taxation. What it means is that whatever these partnership or an S corporation makes, at the end of the year, the profit flows in into your personal tax return. That's what it means for pass through taxation. So pass through taxation is a feature of certain businesses, entities like S corporations, LLCs, when they choose to be taxed as an S corp, partnership, and sole proprietorship. It means that the income, deductions, credit, losses of the business pass through to an individual tax return of the owner or shareholders, avoiding the double taxation that C corporation faces. Detailed example of a pass-through taxation in S corp. Imagine you are a S corporation, Zenith Solutions, which specializes in consulting services. For the fiscal year, Zenith Solutions earns a net profit after all business expenses that have been deducted of 200,000. Step 1, allocation of income. As the sole shareholder of Zenith Solutions, you're entitled to 100% of the S corporation profits. Therefore, the entire $200,000 of net profit passes through to you personally. Reporting on personal tax return. You report this 200,000 of income on your personal tax return, Schedule E, supplemental income and losses, which then flows to your form 1040 and is taxed at individual income tax rate. So you're issued a K1 by an S corp at the end of the year when the business tax is remitted, and this K1 information goes onto your personal tax return. Tax benefit illustration. Avoidance of double taxation. If Zenith Solutions were a C corporation, it would pay corporate income tax on 200,000 of net profit. Then, if you decided to distribute some or all of that profit to yourself as dividend, though dividend would be taxed again on your personal tax returns. As an S corp, this double taxation is avoided. The 200,000 is only taxed once at your personal tax rate. What does it mean is, let's suppose you have an C corp rather than an S corp, and you have $200,000 of profit. So this is not a pass-through entity. It means the 200,000 will remain within the corporation. So it is taxed, and you have to pay taxes. And let's suppose next year you want to pay dividend to yourself. So when you get the dividend also gets taxed. So it's a double taxation in the case of C corporation. But you still, the dividends which you get from a C corp, they are at a lower level you're taxed, but still you're taxed. Flexibility in tax planning. This pass-through mechanism allows for more flexible tax planning. For example, if the business has a year with lower profits, your personal tax liability decreases accordingly, which can be beneficial in managing cash flows and investment strategies. What are the considerations? Self-employment taxes. It's important to note that while the S corp structure avoids double taxation on profits, you as a shareholder employee must draw a reasonable salary from the S corp which is subject to Social Security and Medicare taxes. However, any profit distributed beyond your salary is not subject to these taxes, which can lead to a significant tax saving. So that's what it is. Let's suppose you have a profit of 100,000, you withdraw 50,000 as a reasonable salary. So on the remaining 50,000, you'll not be paying FICA taxes. So you'll be saving like 15%. State taxes. While the federal tax benefit of an S corp are clear, it's important to consider state level taxes. Some states do not recognize the pass-through nature of S corp and may tax the S corp at a corporate level, the shareholder level, or both. It's crucial to understand the tax implication on your state. This example illustrates the significant tax advantage of a pass-through taxation of an S corporation, particularly in avoiding double taxation and providing opportunities for tax-efficient income distribution. There's one thing more. In some states, the states allow you to pay the state tax by an S corp, and then it can take a deduction, and further it can reduce your tax liability. So this is one of another tax strategy which is called SOLT. The concept of salary and dividend split. In an S corporation, shareholders who work in the business can receive both a salary as employees and dividend as owners. Dividend means distributions. This structure allows for a strategic split of income that can optimize tax liabilities, particularly by minimizing your self-employment taxes. So, having an S corp and taking a salary, you're gonna save the FICA taxes, which are the employment taxes. Detailed example of salary and dividend split. Let's consider a scenario with a fictional S corporation, Tech Innovations LLC, which has elected S Corp status and is owned and operated by Jane, a software developer. For the year, Tech Innovations LLC generates 300,000 in net business income after all expenses. So determine a reasonable salary. Jane decides to pay herself a reasonable salary for a role which based on the market rate for similar position for the area is 120,000 per year. Uh, this salary is subject to Social Security and Medicare taxes, collectively known as FICA taxes, which both Jane and Tech Innovation LLC contribute to. So next is distribute of remaining profits as dividend. So after paying a salary, the remaining 180,000 can be distributed to Jane as dividend. So you don't pay FICA taxes on 180,000, you just pay on 120,000. So if it's 15%, you're gonna save 115% on 180,000. 27,000. So these dividends are not subject to Social Security and Medicaid taxes, representing a significant tax advantage. Tax benefit illustration, self-employment tax savings. If Jane were opening a sole proprietor or in a partnership, the entire 300,000 of business income would be subject to self-employment taxes. However, by utilizing the S corp structure and splitting her income into a reasonable salary and dividends, only the 120,000 salary portion is subject to these taxes. The dividend portion saves Jane from paying the 15.3% self-employment tax, potentially saving her thousands of dollars. So on the 180,000, which is distributed as a distribution, as a dividend, whatever you call, you're gonna save 15.3%. So you want to make sure when you have an S corp, you need to take a reasonable compensation. And if you're making more money than the reasonable compensation, you're gonna save FICA taxes on the difference. Income tax consideration. Both Jane's salary and a dividend income are reported on her personal income tax. So the form which is produced by a business tax return, it is K1, and through K1 the income flows to the personal tax return. But they are taxed differently. Her salary is taxed at her ordinary income tax rate, and while the dividends are also taxed at the same rate, they avoid the additional self-employment tax burden. Practical considerations. IRS scrutiny. The IRS pays close attention to S corporations to ensure that the shareholder employees are paid a reasonable salary for their work. Paying an artificially low salary to minimize tax and take more in dividends can trigger an audit. The key is ensuring the salary is in line with the industry standards for the similar roles and responsibilities. So it's not like if you're a software developer and you're making 300,000 and you're drawing 50,000 salary. No, that's not reasonable, and IRS may flag your return, and they'll come after you, they'll audit you, and then you'll be resulting in interest and penalties. So to make sure that whatever salary you declare for yourself or you decide for yourself is reasonable. Balance. Finding the right balance between the salary and dividends is crucial. The salary must be defensible as reasonable, yet optimizing dividends can maximize tax efficiency. State taxes. Some states may have different rules for taxing S corporation income, which could affect the overall tax saving strategy. This example illustrates the strategic advantage of salary and dividend split in an S corporation, allowing shareholder employees to potentially save on self-employment taxes. However, it's essential to navigate these decisions carefully, considering IRS guidelines and consulting with a tax professional to ensure compliance and optimize tax outcomes. Understanding reduced tax employment taxes in S Corp. S corporation offer a unique advantage in how earnings are taxed in relation to the self-employment taxes. Only the salary paid to the shareholder employee is subject to Social Security and Medicare taxes known as FICA taxes, while dividend distributions are not. This structure can lead to substantial tax savings, especially for businesses with higher profits. Detailed example of reduced tax employment taxes. Consider Creative Design S Corp, owns by Alex, a graphic designer. For the fiscal year, Creative Design S Corp reported 250,000 in the net business income after taxes. Setting up a reasonable salary. Again, let's suppose you have a salary of 100,000. So if you have $100,000 salary and you have $250,000 of profit, so you're gonna save FICA taxes of $150,000. Um, again, you're gonna save 15.3%. So savings on self-employment taxes. As a sole proprietor, Alex would have to pay self-employment taxes, which is 15.3%, and on the entire 250,000 of business income. So he's only paying the FICA taxes on the salary which is being paid by the business. The remaining flows through K1 to the personal tax return. This results in a significant savings in self-employment tax liability. So if the self-employment tax rate is 15%, the tax savings on 150,000 that is treated as dividends instead of a salary is like 22,950. That's a massive amount. Practical considerations, again, you need to be at a reasonable salary requirement, balance and compliance. You need to balance between what is reasonable, what is not reasonable, and impact on other taxes and benefits. The strategy also affects eligibility for other benefits tied to salary, such as retirement plan contribution. So along with the salary, you can open your own 401k. You can contribute into SEPs. You can open an HSA account. There are different other retirement planning you can do while you are the S corp owner. This example highlights the strategic tax advantage offered by S corporations in terms of reduced self-employment taxes. By carefully planning the split between salary and dividends, shareholder employees can achieve significant tax savings. However, it's essential to navigate these decisions within the IRS rules and consider the broader financial implications offer necessitating professional advice. So the strategies are there, but then you need a professional help to implement in your business. Understanding business expense deductions in S Corp. S Corp, like other business entities, can deduct ordinary and necessary business expenses before passing income to shareholders. This ability This ability to deduct expenses directly from the corporation income can significantly reduce the taxable income that is ultimately reported by the shareholders on their personal tax return, leading to potential tax savings. So, an example, let's consider Green Tech Innovations Escort, owned by Sam, which specializes in eco-friendly technology solutions. For the year, Green Tech Innovation S Corp generates 500,000 in gross revenue. Throughout the year, the business incurs various expenses related to its operations. Here are the breakdown of expenses: salaries and wages 200,000, rent 50,000, research and development 70,000, marketing 30,000, supplies 40,000, total expense 390,000. So net business income calculation is your gross revenue minus expenses, and your before taxes net business income is 110,000. This income of 110,000 is what get passed through to SAM for tax purposes. This is reported on K1. Significantly lower than the gross revenue due to deductions of business expenses. So you need to make sure that you are deducting all your reasonable business expenses. Tax benefit illustration: lower taxable income. By deducting these expenses, Green Tech Innovation S Corp reduces its taxable income from 500,000 to 110,000. If these expenses were not deductible, Sam would have to report the entire 500,000 as income, significantly increasing the tax liability. Operational efficiency: the ability to deduct a wide range of business expenses encourages business to invest in growth, research and development, and operational efficiency. So let's suppose I make 500,000 in my business, I have a manufacturing business, or let's suppose we talk about trucking. We're in trucking. So I make 500,000, and I go out and I invest into truck. I buy truck 123, I buy trailer 123, or whatever it is. So I claim the depreciation, which is a non-cash expense. So you can claim depreciation under Section 179 and reduce your income, and you'll have the cash flows would be positive, and you have lower tax bill because of claiming of non-cash expenses. So for Green Tech Innovations, investing in research and development not only reduces their taxable income but also supports the company's mission to develop eco-friendly technologies. Practical consideration: documentation and compliance. It's crucial for S corporations to maintain records of all expenses to substantiate deductions. Proper documentation includes receipts, invoices. So, what it does mean is whatever expense you do or whatever deductions you take, you should have proper backup. You should have the backup for all the expenses so that if tomorrow there is an IRS audit, you have everything to show them the basis for which you took the deduction. Understanding deductible expenses: not all expenses are business expenses. It's important to understand the expenses are considered ordinary and necessary according to the IRS guidelines. So these two different very important terms: ordinary and necessary. Consulting with a tax professional can help ensure that deductions are maximized legally and effectively. Impact on shareholder income: while reducing taxable income through deductions can lower tax liability, it also reduces the net income passed through to shareholders. Shareholders should consider their personal income needs and tax planning strategies when making decisions about business expenses. So let's suppose the trucking company makes 500,000. They want to, the owner needs 100,000 for himself for the year, and his expenses are maybe like 350,000 or 300,000. So he has to decide accordingly how much money he's going to keep in the business, how much he's going to pay him, and that according to that you project for the expenses. This example highlights how S corporations can use business expense deductions to lower their taxable income, ultimately benefiting the shareholders by reducing their overall tax liability. The strategic use of deductions require a balance between optimizing tax savings and supporting the operational and growth needs of the business, all while ensuring compliance with tax laws and regulations. So, what does it means is you're optimizing the tax savings by investing in your business. When you're investing in your business, you're supporting the growth and the operations of the business, and you're still in compliance with the tax laws. Understanding fringe benefits in S Corp. Fringe benefits are additional compensation provided to employees, including health insurance, retirement plans, and other perks. In an S corporation, the tax treatment of fringe benefits can vary, especially for the shareholders who own more than 2% of the company's stock. While some benefits may be tax deductible for the corporation, they might be taxable as income to the shareholder employee with the potential for personal tax deductions. We will talk about the health insurance. So consider an example. Consider Bella's Boutique S Corp, a retail business owned by Bella, who's both the sole shareholder and an active employee of the corporation. Bella's Boutique offers several fringe benefits, including the health insurance and the 401k plan. So, by the way, this is a tax planning strategy, a very good tax planning strategy wherein you invest in yourself through the business. Health insurance for the corporation. Bella's boutique pays 10,000 annually for Bella's health insurance. This expense is fully deductible by the corporation as a business expense, reducing its taxable income. For Bella, the 10,000 is reported as an additional wages on Bella's W2, increasing her taxable income. But wait, however, Bella can deduct the health insurance premium on her personal tax return, offsetting the income increase and effectively receiving the benefit tax free. So this is a very good tax strategy. Again, 401k plan, the corporation contributes 5,000 to Bella's 401k plan. The contribution is deductible as a business expense, similar to other employee salaries and benefits. For Bella, the contribution made by the corporation to the 401k plan are not included in Bella's taxable income for the year, providing her with a tax advantage way to save for retirement. So, Bella will not pay on the company's contribution to her 401k plan, and the corporation gets a deduction for whatever it contributes for the employee's 401k plan. So, very good tax strategy. Deduction of fringe benefits. The corporation benefits from deducting the cost of fringe benefits, reducing its overall taxable income. For Bella, despite the health insurance premium being added to her W 2 income, the ability to deduct these deductions on her personal tax return neutralizes the tax impact, allowing her to enjoy the health insurance benefit effectively tax free. So, your money is working for you. Retirement savings advantage. The contribution to the 401k plan are made with pre-tax dollars, reducing Bella's taxable income and providing a tax efficient way to save for retirement. So if your limit is 6,000, your limit is that's IRA, but a limit is 23, 24,000, something like that for the 401k plan. So yeah, and that goes out of your W2 incomes. That's 100% deductible. So that's a saving. The funds in 401k grow tax deferred until withdrawn. Practical considerations. Again, we need to talk about the documentation and compliance. We want to make sure whatever we do, we have the backup. Proper documentation and adherence to the IRS rules are crucial for the tax advantage treatment of fringe benefits. This includes ensuring that benefits are reported correctly on the tax forms and that any deductions taken on personal tax forms, tax returns are justified. Balancing benefits and salary for shareholder employees, particularly owning more than 2% of the S Corp, it's important to balance the provision of fringe benefits with the requirement to take a reasonable salary. Both components should be a part of a comprehensive compensation strategy that maximizes tax advantages while complying with the IRS rules. So what it means is you take salary, then there are fringe benefits like you can contribute to HSA, you can contribute to IRA, you can contribute to 401k, and there are you can contribute to SAP. There are so many options. Personal tax deduction and your health insurance. So, personal tax deduction. Shareholder employees should consult with a tax professional to understand how to properly deduct health insurance premiums and other benefits on their personal tax return, ensuring they receive the full tax benefit available to them. This example underscores the Tax treatment of fringe benefits in S corporations, especially for the shareholder employees who own more than 2% of the company. While there are clear tax advantages to offering and receiving these benefits, navigating the rules requires careful planning and compliance to maximize benefits and minimize tax liability. So, at the end of the day, we all have one goal. We need to maximize the benefits and minimize the tax liabilities. Understanding estate planning benefits in S Corp. S Corp provides a structure that can be advantageous for estate planning, particularly because shares of the corporation can be gifted or transferred to heirs or trust under certain conditions. Uh, this can help in gradually transferring wealth, reducing the size of the estate, and potentially minimizing estate taxes, all while maintaining control over the business until the shareholder is ready to fully transfer operations. Example: Legacy Builders S Corp, a construction business owned by Jordan, who is planning for retirement and wants to ensure a smooth transition of the business to his children, Casey and Alex, without incurring significant taxes or disrupting the business operations. Over several years, Jordan decides to give shares of Legacy Builders S Corp to Casey and Alex, utilizing the annual gift exclusion, example 16,000 per participant per year as of the last known figures, to gradually transfer ownership without triggering gift taxes. These gift reduces Jordan's taxable estate while allowing Casey and Alex to become gradually more involved in the business. Because the S Corp is a pass-through entity, the income attributed to the gifted shares passes through to Casey and Alex, potentially taxed at a lower rate if they are in a lower tax bracket. So you're going to use the gift tax loophole wherein you can gift your near ones to a limit every year, and that's how you pass your wealth to them. That's one of the strategies. Establishing trust. Jordan establishes trust for Casey and Erics and transfer S Corp shares into these trusts, providing further control over how the businesses and assets are managed and distributed over time. What is the benefit? This allows Jordan to specify the terms under which Casey and Alex gain control of the assets, providing protection against creditors and divorce settlements, and potentially offering tax advantages depending on the structure of the trust. So there are different type of trust, and this is a very complicated matter. One should consult an attorney when establishing and passing the assets in the trust. Estate tax reduction. By gifting shares annually within the gift tax exclusion limit, Jordan can significantly reduce his taxable estate, potentially avoiding or minimizing the estate taxes upon his death. The income from the S Corp attributed to the gifted shares is reported by Casey and Alex, which can result in overall tax savings if they are in the lower tax bracket compared to Jordan. What are the practical considerations? Adherence to the S Corp ownership rules. It's important to remember that the S Corps have restrictions on the number and type of shareholders. Shareholders must be individuals, certain trusts or estates, and an S Corp cannot have more than 100 shareholders. Planning must ensure compliance with these rules. Valuation of shares. Poor valuation of S Corp shares is crucial for tax proper valuation of S Corp shares is crucial for tax purposes, especially when gifting shares or transferring them into the trust. This often requires professional appraisals to determine fair market value and ensure compliance with the IRS guidelines. Professional guidance. Estate planning, where the S Corp shares involve complex tax laws and regulations, it's advisable to work with estate planning attorneys and tax professionals who can provide guidance tailored to specific circumstances and goals. This example highlights how S Corp can be effectively integrated into estate planning strategies, offering benefits such as tax efficient wealth transfer and facilitating business succession. However, navigating the complexities of estate planning and S Corp regulations require a careful planning and professional advice to maximize benefits and ensure legal compliance. In conclusion, S Corp presents significant tax and operational advantages for business owners, from pass through taxation and strategic income splitting to reduce self employment taxes and deductible business expenses. These benefits extend to offering tax efficient fringe benefits and facilitating estate planning. However, maximizing these advantages requires careful planning, compliance with IRS guidelines, and often professional advice. S Corp can be a powerful tool for tax efficiency and business growth when navigated correctly, underscoring the importance of informed decision making and strategic financial management. Again, my name is Manmeet Saluja. I'm a CPA and an enrolled agent. I specialize in trucking industry and love to help, whether it's accounting or tax. Feel free to contact me for no obligation call. Thank you and see you next week. My phone number is 832-848-5155 and my website is manmeetsalujacpa.com. Thank you for being there. We'll see you next week and thank you so much.